everyone. I'm Rita Garwood, editor-in-chief of ABF Journal. Joining me on the podcast today is Damian Dwin. Damian is founder and CEO of Lafayette Square. Damian, can you tell us a little bit about yourself and your company?
Sure, and thank you, Rita. Lafayette Square is an investment firm in the private credit space focused on working class people and working class places. We seek to generate outperformance by carefully underwriting opportunities in businesses where we can also deliver managerial assistance. We know helping companies reduce turnover and increase healthcare and retirement benefits for their workers results in outperformance over time. We also know, as a firm named after a park in Washington, D.C., if you're able to generate capital at a low cost, it significantly improves your performance as an investment manager when you re-lend that money at a spread. And so today at Lafayette, we borrow at 6% and lend at 11% in round numbers. Um, because of our focus on working class people and working class places, we're actually able to attract attractive financing. So have a great day job, really excited to interact with entrepreneurs on a daily basis, helping them grow their business. And of course, we'll talk about it in a moment, but this is a topical industry. The middle market employs 50 million workers. So that's about a third of our labor pool. 140,000 companies. There are a lot of businesses that need this type of capital.
Well, thanks for explaining all of that and setting the stage for our discussion. So, you recently wrote an article, which is being released with this podcast on ABF Journal for those who want to read it. It's called Private Credit and the Right Side of History: The Case for Non-Sponsored Lending. And in that article, you point out that the private credit industry overwhelmingly focuses on large sponsor-backed companies, which are often located in wealthy areas, while ignoring a massive segment of the market that you just talked about, including non-sponsored middle market businesses, many of which are in working class communities across America. What led you to choose that framing?
The market's super competitive, and differentiation is the only calling card I believe one can have if you expect to earn uh, shelf space with investment allocators. The largest players have household names and raise a lot of money from retail, insurance, pension, endowment, foundation, the works. And interestingly, when you study the returns of these firms, uh, the dispersion is pretty narrow. There's not a lot of difference. And so, in deference to investors, there's no reason to give a dollar to a manager who does the same thing as someone else. I think differentiation is the um, most important attribute to your outperformance. It goes without saying we all have to make money. How we make the money and what that money does is something where people are open for conversation. And we researched this extensively. Yeah, I've been doing this for many years. Um, and it was very clear that there was a crowded trade in sponsor lending to large EBITDA businesses, whereas smaller EBITDA companies have largely been underserved by their regional banks and largely abandoned by private credit, which has moved higher and higher up the EBITDA scale. That was an opportunity for differentiation. Interestingly, differentiation in both the assets and the liabilities that we could present to investors. On the liability side, it opens you up to attractive programs in Washington, D.C., like the SBIC program, where the Small Business Administration is prepared to lend at treasuries plus a spread. Uh, that's far more cost effective than you can get in the capital markets. It also opens you up to negotiating unique arrangements like the one we created with ING, where we actually get a lower interest rate based on proving that we have delivered services to working class people and working class places in our portfolio. On the asset side, of course, below 50 million EBITDA, non-sponsored risk, which makes up the lion's share of investable private credit opportunities in the United States, has been ignored by a private credit industry that today hopes to average 100, $200 million EBITDA in portfolios that are 90% sponsored. So it's differentiation.
So, what sparked your conviction in non-sponsored lending as both a moral and financial imperative? Was there a turning point or a personal experience that shaped this vision?
Let's start with the profit incentive. I think this is lucrative, and a dispassionate view of the data would suggest you can make a lot of money doing this and outperform peer organizations. So the money is where I begin because it's interesting, it's scalable. Um, in the context of making money, embracing this conversation about geography being place based and embracing this conversation about working class people opens you up to a way of thinking that actually can reduce risk in non-sponsored portfolios. So often we have been um, fed a narrative that lending to a small and medium-sized business in America is only safe if a private equity fund is at the table. And it's untrue. And it's offensive to the 100,000 plus entrepreneurs who don't have a private equity firm in their cap table and employ tens of millions of Americans and work really hard and build a lot of wealth for themselves and their community. They are investable, and they need growth capital, and they need the ability to roll debt and make acquisitions and all the things that business owners require. And they do just fine with their audited financials and their growing businesses in the absence of a sponsor. So as you start to peel back the layers of how private credit has grown over the last 20 years, uh, we've clearly seen a march up the EBITDA scale. Uh, the leverage finance business that I entered in the 90s when I graduated college and trained at Goldman Sachs routinely financed terrific businesses at 20, 30, 40 million EBITDA and viewed them as really interesting credits. And back in those days, we would lend money to companies where we had covenants and bank meetings going into syndicated transactions. You fast forward today, you see a lot of behavior that to me is missing the mark. It's not only leaving smaller EBITDA businesses behind, it's embracing imprudent and riskier lending standards for large companies just based on size bias and convenience. You see fewer covenants in the larger EBITDA situations. You see more add backs and adjustments uh, to EBITDA. It's a different business. In fact, you actually see just higher leverage and lower coverage on an outright basis. So it's a pretty exciting time to stick with the fundamentals and do things the way that I was trained to do them, which is to be very conservative, thinking about how to get repaid in things that are growing and audited, where we can actually make a difference beyond capital. And that's the root of managerial assistance and working class people, working class places. We can make a difference, and we get to enjoy that experience every day with the portfolio we've created.
So, in the article, you argue that capital is exported out of working class communities. Can you unpack how that happens and what that means for the economic resilience of those places?
My father was a bus driver, and my mother was a civil servant for 40 years in the federal government. And because of their hard work, I was afforded incredible opportunity. I got to go to prep school in Georgetown and got to build a career on Wall Street, Goldman Sachs, Credit Suisse, and had all these great opportunities. When I asked my parents, who are now enjoying their fixed income, um, how exactly is your money invested? They can answer the question by asset class. But if I ask them about the amount of money invested in parts of the country that I know they care about, the conversation shifts. My mother, a Washingtonian, my father from East Texas, would be shocked to know how much of their retirement money is in California, Texas, Florida, New York, Illinois, markets very far from Washington, D.C., where they live in retirement. And it's a common challenge that we face where firefighters, school teachers, bus drivers, retail investors in general somehow disassociate investment returns from the geographic location of their money. And what you find is most of private credit, for example, is invested, in fact, in just 5 states: California, Texas, Florida, New York, Illinois. Within those states, the money is invested in high income zip codes. And so you have people from 45 states who are visibly exporting their money from Iowa, Nebraska, Oklahoma, Louisiana, Georgia. They're sending their money to other markets. When I know there are terrific local investment opportunities in good growing middle market companies where they can make double digit net returns and see economic mobility in their own community. It's incumbent upon investors like me to not only frame the issue, but deliver investable solutions that geographically align people's money with their community and what they value. And I think people value more than just the state of return, particularly when you have evidence that the state of return can look very similar in your own community as it does far from home in California, Texas, Florida, New York, so forth.
What do you think that would look like from a typical investor standpoint, like your parents who might not know as much about an investment? Usually, you have an advisor giving you suggestions, or you say, yeah, that looks good according to the synopsis of the investment. How do you think what you're talking about can come into fruition if there's more investors like you?
Performance. It's everything. It's capitalism over time. And markets are inefficient in the short term and very efficient in the long term. And as firms like mine show results, audited and regulated, advisors and investors will migrate their capital and their attention to places that align with their values. Today, we have a crowding effect where a lot of firms are trying to look like five industry leaders who essentially have the same strategy. If you actually look at the investments owned by the largest players, they overlap 50% of the time in some of the flagship strategies in private credit. So you could pay a management fee to any one of the five and you get the exact same deals. To own two or three of them is to double or triple down on the same investments. That's not value add, which brings us back to what we discussed earlier in the call. Differentiation is so important if you want to be um, an insurgent that grows. And I believe over time we will call balls and strikes and give witness to firms who outperform, who's delivering the highest risk adjusted return, meaning you not only pay attractive dividends, but you have fewer defaults and non-accruals, who has more transparency and data about how they've differentiated themselves. For example, turnover in the portfolio, what's actually happening with workers getting fired, healthcare and retirement adoption by the employees in the business. That stuff matters and impacts EBITDA and ultimately dividends paid to investors in a credit fund. I think in this world of AI and transparency, we're going to see more attention paid to these matters, and we'll ultimately see more differentiation and segmentation within private credit. You're already starting to see the rise of industry specific funds. I think it's inevitable we'll see geographically specific funds. And I think we at Lafayette Square are ahead of the conversation about socioeconomic funds, funds that think about working class people and places and how to thoughtfully, conservatively invest in good growing businesses in those markets where you can generate great returns.
So earlier in the call, you mentioned how private credit investors you tend to think that sponsor-backed companies are a safer bet. In your view, what blind spots do they have when it comes to assessing risk in non-sponsored businesses?
The data shows that the leading indicator of default risk is not size, it is leverage. And so we all um, need to be reminded as we take bigger and bigger risk, with or without covenants for that matter, where are we on leverage? And of course, coverage, right alongside. Um, I personally really like below 4 times leverage on middle market businesses. I think lending at 5 or 6 or 7 times is too much leverage. That's the way I was trained. That's how I think and feel about risk. And I think there's a lot of data to support the performance of portfolios that have less than 4 times over time as compared to portfolios that have more than 4 times. Um, the loan to values, which correlate with these LTVs, I personally prefer lending below 50% LTV because I think it's a conservative, prudent approach. Um, and so these proxies for leverage are the leading and most important indicator of default risk. And rating agency research supports this approach. To layer onto leverage covenants, where you have the ability to force a conversation to the extent a business underperforms, is critically important because in private credit, this is essentially a fixed income investment where we have capped upside and a lot of downside. So it is so important we are thoughtful and meticulous about seeing that we have multiple ways to get repaid on an investment. And there again, size bias can lead you astray to focus on the wrong things when you're underwriting idiosyncratic credit risk. I think it's so imperative to just be consistent. I like recurring revenue businesses in industries that are familiar. For example, healthcare, franchising, business services, transportation logistics, businesses that are audited and growing. And in that frame, where there's not only sufficient economics to pay our rate, but where we actually believe we can help improve the business by reducing turnover and increasing healthcare and retirement. That is the package. And on a day-to-day basis, we're trying to negotiate all of these dynamics with 140,000 different companies in this vast multi-trillion dollar opportunity set that is the US middle market. Um, Interestingly, I think borrowers are more than happy to engage in conversations about covenants, leverage, coverage, and how to help their workers. But they really want to see a lender who is steady and consistent and can grow with them to the extent they perform. And a lender who's not looking to be a distressed player who just takes over their company at the first opportunity. Um, and a lender who's fair about the downside protection. We think 5-year maturity and something that's growing, where you can also have a loan to value less than 50% and leverage 4 times or less, is a very comfortable place to be. And that works whether you're talking about a 100 million EBITDA business or a 20 million EBITDA business. The negotiating power for the bigger EBITDA companies has shifted in such a way that they can now borrow at tighter spreads and often without covenants because the demand for capital investment is so great from new and big credit funds they're willing to compromise on lending standards. And I just think I think it's a dangerous game, and I'm much happier um, taking the prudent conservative approach.
Makes a lot of sense. So why do you think that myth persists that bigger is better, and these deals are inherently safer and more profitable? If there's data like you just outlined, why do people still believe in that myth?
Two reasons. First, it's easy um, to originate deals by just talking to private equity firms, as opposed to going out and having relationships with 140,000 different companies. Instead, you talk to 40 PE shops as opposed to 140,000 individual companies. So ease is one big glaring reason. The second is money, it's a profit incentive. If you have a bigger fund, you charge more fees, you get more carry, and so yeah, there's a size bias. Why not do fewer transactions in bigger companies as opposed to more transactions in smaller companies? Um, when if you do your job correctly, you're going to invest all the time and energy to write a 50, 75-page memo and spend weeks or months negotiating documents and conducting due diligence. There's just this inherent size bias because it's easy and it's really lucrative for the general partner or the investment manager. I don't believe that's inherently good for investors. And I certainly don't believe that's inherently good for our economy or our society. We know that entrepreneurs are very unhappy with the service they're receiving from regional banks. And we know entrepreneurs are not fans of private equity focused credit shops who just outright won't even call them back or talk to them until a PE shop is at the table to lend them money. It's problematic. And going back to the geographic piece we were discussing earlier, when you have 50 states and most of the money goes to 5 states, it can be a tough pill to swallow when you're creating jobs and economic mobility in your community and your cost of capital is structurally higher just because of geography.
So everything that you've said so far makes a really compelling case that non-sponsored companies offer better pricing, less competition, more flexibility. Why do you think more institutional investors haven't moved into this space yet?
I have a lot of patience for institutional investors who I believe over time will see the efficiencies and the opportunities that come with the outperformance generated by non-sponsor lending. But at the end of the day, it's on non-sponsored lenders to outperform. Now, one of the dynamics in credit, which makes it really interesting, and it's a quirk in our business that's different than other businesses, um, the dispersion of returns for leading managers is sufficiently narrow that just to put numbers on it, if you can make 14% doing non-sponsored lending and someone else could deliver 12% doing sponsored, there's a class of investor who will say 12 is enough. They don't want the extra 200 basis points. It's not everyone, but those people do exist. Uh, Even if you show that the unit of risk for that 14% is lower than the unit of risk for the 12%, there's some people who, again, just focus on the headline number and what's easy. Um, our business has evolved to a place where we're not really competing on fees anymore. So it's hard to be sort of the low cost um, credit manager. None of us has index fees. Um, Leverage is diverse in our business. There's some people who are able to borrow cheaply in DC. There's some people who cannot. They can only use CLO technology or other sources of leverage. But on the asset side, most people are lending somewhere between SOFR 400 and SOFR 800 in these portfolios. So these questions about how much incremental return makes it interesting is a part of the dynamic in sponsor lending versus non-sponsor lending. And I think, particularly with interest rates likely to go down in the quarters and years ahead, there will be greater focus on the outperformance in hundreds of basis points that I believe can be found, taking less risk based on leverage and coverage and LTV. Um, and I think where this ultimately goes is not to villainize sponsor lending versus non-sponsored. It's to add shelf space so that there's a complement. Because I think the diversification that non-sponsored presents in this crowded market for sponsored lending will be very attractive to allocators who say, hey, this is interesting. I can buy something that has less correlation with what I already have and actually has less unit risk while paying a terrific spread. But performance is key. Firms like Lafayette Square have to just keep putting up numbers and showing that it works and that there's a lot of data to support it.
So can you speak to the scale of the opportunity, especially in that 10 million to 50 million EBITDA range, and why that part of the market is being overlooked?
It's the biggest trade in private credit. It's indisputable. There are far more companies in that range than there are in the 200 million EBITDA to 300 million EBITDA sphere. So uh, there are a ton of great companies in all 50 states employing tens of millions of Americans that need capital, um, and it comes in many forms. From a narrative perspective, you've witnessed large players say, "Well, sponsor lending is a terrific opportunity. You should have an allocation." In addition, investment grade loans to private companies are a terrific opportunity. You should have an allocation. Oh, let's talk about asset-based finance. You should have an allocation. When you unpack it, what's really going on is anything that can be rated investment grade, privately or publicly, that fits insurance companies is being labeled interesting because insurance companies have a voracious appetite for spread product. That makes sense to me. I get it. When you start to bring retail investors into that at scale, um, it's tough to say to retail investors, and even in pension funds and endowments and foundations, the only way to articulate your views in private credit is to ignore the largest opportunity set, which is family, founder, entrepreneur owned businesses who are 150,000 plus in this country with revenues between $10 million and $1 billion. You shouldn't bank them because it's too much work. Do something easier by banking just a small 10%, 20% minority that's got an investment from private equity. That's the only safe place to to touch a third of the American economy. It doesn't make sense. Now, our economy is about a third, a third, a third. Um, Large public companies, think Amazon, Walmart, um, privately held businesses, revenue less than $1 billion, all the way down to $10 million, what we've been discussing today. It's about 50 million workers in the first category, about 50 million workers in the second category. And then, and this will make sense to you, government workers, federal, state, local, that's 50 million Americans. Like, government policy matters. This is why we named our business Lafayette Square. We really believe in thinking about public policy and aligning with the intentions of Congress and the wishes of shareholders. Um, I think it's a mistake to ignore tens of millions of workers and good growing companies where you can have audited financials and make really smart risk adjusted investments at low LTVs where you can earn a terrific return. And importantly, Washington is providing tremendous incentive to private credit to lean into non-sponsored. This is very little discussed. If you took a poll in DC of legislators on both sides of the aisle, no one would say it's a bad thing to drive capital to working class people and working class places and to directly finance entrepreneurs. And they would point out legislation that's been passed for decades and new incentives, including the One Big Beautiful Bill, provide myriad incentives for Small Business Administration, um, the Environmental Protection Agency, uh, and of course, the Department of Agriculture and others to see that capital is going to communities and people in transaction sizes that are inherently smaller, meaning less than $20 million, less than $50 million transactions. So this size bias actually runs afoul of the wishes of DC. DC wants to see capital flow in smaller quantums at higher volume in places and to people that are the focus. It is not just 5 states and rich zip codes within those 5 states.
So I want to go back to talking about covenants. You talked earlier about when you got into this industry, covenants were just a matter of everyday life, and now not so much. Are there misconceptions about covenants and structure that you feel need correcting? And what does the data tell us about recovery rates and covenant light lending?
Well, recovery rates are visibly worse when you don't have covenants. In addition, we we know it's easy and comfortable to believe just because a company's big, it won't default. But the data doesn't substantiate it. The data shows leverage will drive a business to the brink before anything else. So um, most companies are brought to a place where they want to borrow because they're trying to finance growth without diluting themselves. They like that idea of uh, putting a conservative amount of leverage on the business to make an acquisition or to fund working capital or to refinance some existing debt on the business. And for regulatory reasons, regional banks have become constrained in their appetite to grow with companies um, in this non-dilutive way. Private credit has um, directed its attention toward bigger companies for reasons discussed. There's a size bias. And so what you're seeing is smart lenders not only coming forward with the capital, but also uh, using disciplined, proven methodologies to reduce risk for shareholders in a fund or limited partners, whatever the case may be. And that begins with prudent underwriting, conservative leverage attachment points. I like 4 times and less, coverage of 2 times or more, loan to values less than 50%, ideally. Um, and um, if you do that, the data shows over time you can do well, particularly if you have properly diversified your portfolio, which is another matter altogether. The top of the funnel has to be really big to do a good job in this business. You need to have selectivity of 2% or less. So you can't invest in everything you see, but it's really important that you see a lot so that you can make the right structuring decisions and give management teams capital that reflects prevailing market prices. All of this ties to the research and analysis from the rating agencies about defaults and recoveries. Um, Industries, as we move through the economic cycle, will move in and out of favor. So it's not linear. But there are certain industries that will always be with us where there's just voracious appetite and demand for capital. Food franchising would be an example of that. Data centers would be another. These could not be more different. But we know in our lifetime we're going to need to eat and we're going to need access to the internet.
Very true. So earlier you talked about how Washington right now is really kind of backing non-sponsored lending in general. In the article, you mentioned the Trump administration's pro-tariff stance and programs like the SBA's Made in America initiative. How do you see current and future political dynamics shaping the lending in non-sponsored companies?
Sure, it's all connected. The debt and the deficit are never to be ignored. So when you study the budget, the federal government is going to continue spending on defense, healthcare, and of course our debt service for the rest of our life. These are multi-decade economic challenges that we have embedded in the federal budget. Um, and the debt um, obviously bleeds into a conversation about our currency and how the Fed is handling short-term rates and the shape of the yield curve. This is all connected to what happens in private credit, where the government is basically saying through policy it wants to see good jobs created onshore in businesses that um, have more of an export bias. Now, when you foot that with our service economy and the fact that we actually aren't as much of a manufacturer as we used to be, you very quickly come to the conclusion the government wants to engage in a series of public-private partnerships, formally and informally. The government is prepared to recycle taxpayer dollars to incentivize our citizens and foreign investors to put money in places and in industries that the government deems strategic. And I think that conversation will continue in both Democratic and Republican administrations for years to come. It's not going to go away. And so existing programs are going to get bigger, even with DOGE reducing headcount at the Department of Agriculture or the Small Business Administration. The budgets within those agencies, the Department of Defense, they're all going to go up. And where appropriate, and we've seen significant movement even in the last 6 months, you will see meaningful lending and government guarantee programs emerge to try to realign where capital flows and to incentivize mature and venture capital businesses to show up differently. And I think it all comes back to jobs. We have we have 150 million workers um, who need full employment in jobs that actually pay a reasonable wage and give people a shot at economic mobility. This is part of the reason why we're so meticulous at Lafayette Square in tracking and measuring student loan debt, medical debt, home ownership rates, FICO scores. The lived experience of your average American worker is is fraught. It's little discussed that the 2/3 of working class people live check to check in this country. Those are our family members. Those are our coworkers. Those are our neighbors. We can't pretend that everyone is working in a high wage situation with a liquid savings and great health care and good food and a good home. It's just not reality. And the private sector has an important role to play in this in concert with the government. The government is trying to send signals and create incentives. I think there's a lot more to come because the need, as expressed by voters, we're already hearing it, and I think we're going to hear and see more of it.
So earlier, you talked about the incentive for investing in these non-sponsored companies, that it's profitable. But some investors might feel torn between, maximizing returns or doing the right thing. In the article, you suggest that that's a false choice. Can you explain that?
Sure, let's ignore all talk of doing the right thing. Let's just keep it in the realm of do what's in your financial best interest, and we're all economic animals in this um, capitalist system. Following that mindset to its logical conclusion will lead you to the very same place. There's no scenario in which we win by ignoring working class people and working class places. It is the largest investment opportunity with the widest spreads. And on a risk adjusted basis, there are a lot of opportunities to add value with lower leverage, higher coverage, and importantly, a healthy, productive, complementary relationship with workers to aid and assist CEOs in reducing turnover, which no CEO likes, and increasing healthcare and retirement adoption, which, under our current rules with today's system, is utilized just not enough. The data shows working class people are enrolled in healthcare and enrolled in company offered retirement 25% of the time. It's staggering. So when the vast majority of your workforce doesn't use your benefits because your benefits are too expensive, you create conditions where they're less likely to be loyal and stay at the company. And we know the replacement value of a worker and dealing with turnover undermines EBITDA and growth for a company. So it's all connected. And in our case, in Lafayette Square, we believe you can negotiate terms with your leverage providers. In our case, ING provides us with a revolver. We get an interest rate step down on our revolver for making progress toward our 2030 goals. By 2030, we committed to create 100,000 working class jobs, invest 50% of our capital in working class places, and see half of our portfolio companies adopt managerial assistance. It's good business. It gets us a lower cost of debt, which means a higher shareholder return, but it also gives us a major incentive to reduce risk in our portfolio of sponsored and non-sponsored loans by driving turnover down and increasing healthcare and retirement in the same breath that we are monitoring leverage and coverage and EBITDA margins and growth for the businesses we finance. The fundamentals lead us to reconcile with the human capital component, the managerial assistance component, in the same breath that we behave as financial engineers who just think about statistics.
So I'd like to go back to the geographical angle that we were talking about a while back. What do you think it would take for the private credit industry to truly serve all 50 states? And what stands in the way of getting there?
I think private credit is a rising tide and an expanding ecosystem that inevitably is going to move in the direction of specialization. And so I think 10 years from now, we'll be having a different conversation than the one we have today. So that's one piece. Uh, Give this time, I think water finds its level. On the other hand, um, I think investors are smart and will come to the conclusion they shouldn't drive 5 states away to find returns when there's great stuff to do at home. And in this uh, environment of tariffs and interest rate moves and equity volatility and artificial intelligence, there's going to be a lot of good common sense infused into the conversation about how can I make 10 to 12% with the least amount of risk. And ideally, I'd love to see people in my own community have a better shot and more economic mobility. All respect due to colleagues and friends in other states. What can I do here in my home? I think that's how people will talk in North Carolina and Louisiana and Utah and Washington State, Idaho. I think it's just inevitable we're going to get savvier about saying there has to be some allocation of capital to credit in my home market where I know I can not only get my money back, but earn a nice return and see jobs stay right here in my home market.
Yeah, that would be fantastic. So you mentioned that in 10 years, the conversation that we'll be having will be completely different. Can you tell me how you envision the conversation 10 years from now?
Gosh, that's such an interesting question. And even with my vivid imagination, I can't say the crystal ball totally reveals. I'm certain that the federal government will continue to be an active and strategic provider of fund finance to private credit. So existing programs like the Small Business Investment Company program in DC will be bigger. Um, that's the arc of things we've seen since the 1950s to today with the SBA, and I think it's only going to increase with time. I think the data and by extension the comfort level with non-sponsored risk um, is going to improve. We live in this age of artificial intelligence and big data. Soon enough, the machines will give us even more insight about the investment performance of the 140,000 companies in the middle market. And I think that's going to lead to more allocation of capital, particularly as leading firms build decade plus long track records doing sponsor lending and outperforming peers. As I said, in the short term, markets are inefficient. In the long term, they're very efficient, and that outperformance will be rewarded with additional capital.
So you end the article by saying that working class communities are the largest domestic investment opportunity of our lifetime. Um, what do you hope that investors will take from that claim?
Well, the last sentence in the piece is bet on America. So that's what I want people to take. Um, I want us to bet on each other. I'm an optimist and see incredible opportunity doing great business here at home and aligning with workers to have stability and growth, loyalty and performance in our middle market companies. Our society, our economy does not work in the absence of these small, medium-sized businesses. We can't have only large public companies in this country. We can't have everyone working for the government. We need small, medium-sized business to employ and to grow and to thrive. Um, and as a result, we have an opportunity to bet on America. Um, I don't subscribe to anything that speaks negatively or turns its back on my fellow Americans. I think that this is a big tent, and the middle market is critically important under that big tent, and it does not function without working class people in working class places feeling respected, seen, having opportunity. And I think the capitalist system can align with and reward that mindset and those values.
Definitely. Well, thank you so much, Damien. Appreciate you going through all of this and writing the article. Any final thoughts as we wrap up?
Love your publication. Thank you for what you do, ABF.
Thanks so much for being on the podcast today. It's been a great conversation.